Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. For solicitation or to buy or sell any security, either the host, guests, or clients of either may own securities discussed on this podcast. Go! Welcome to the Special Situations Cast. My name is Bram de Haas. I'm founder of Social Capital and the author of the Special Situations Report at Seeking Alpha. I'm hosting this podcast that's focused on learning about markets and companies in a way that active investors can build on and translate into actionable ideas. Today, I've got a very special guest in Evan Ratner. He's the SPAC Portfolio Manager, Easterly Alternatives. Welcome, Evan.
Great to be here, Bram.
Thanks for coming on. I'm real excited. SPACs are all the rage right now. Yeah, and I think you recently launched. Can you tell me a little bit about what you're doing at Easterly, and maybe a little bit about your background so people know where you're coming from?
Yeah, sure. I'll start with my background, and then we can kind of get into what we're doing today. So sure. I graduated from Emory University in 2007. I went to go work for a family office where we were doing risk arbitrage, special situations investing. Left there in 2009 to join John Paulson's first head of research at his family office, doing merger arb, special situations, real risk reward detailed investing there. In 2014, I left to join Levin Capital, the predecessor of my current firm, to help co-manage, be the co-portfolio manager on our event-driven fund, as well as join our large cap value fund. In April of 2019, Easterly purchased Levin Capital, renamed it Levin Easterly Partners, which is a multi-billion-dollar value manager. So we are large cap, mid cap, and all cap investors there. And then I continue to run our Special Situations Fund, which is focused on SPACs, which is now part of Easterly Alternatives, where we're raising a $100 million fund, the first vintage, and we're looking to raise basically multiple vintages every couple of years. And the plan here is to raise capital for institutions and family offices who want access to SPACs, who may not have time or the knowledge to diligence them or the access to the SPAC managers like we do. So we're going to build a portfolio of 10 to 15 of the highest quality SPAC sponsors and have a 4-year life of that, about 1.5 years to invest and 1.5 years to harvest or have them invest in transactions. And then we're going to continue to roll forward with multiple vintages. So that's kind of where we are today. And that's a little bit about me.
Okay, cool. So, and you're talking about vintages. Does it mean that they have like limited duration or?
Yeah, the goal is to do about a 4-year lock and then continue to do the next one. Because ideally we can have 10 or 15 SPACs. Somebody great comes out to market and they say, famous investor A launches a SPAC and we invest in it and they want to come back to market. It could be in our second fund. And Brent, does it make sense for me to explain what a SPAC is and why they're popular today to the audience?
Yeah, I definitely wanted to ask if you wanted to do that. So that would be great.
Yeah, so perfect. So SPACs is an acronym for Special Purpose Acquisition Company. They've been around probably since the late 80s, early 90s. Been investing in them since 2007, but really since the last 2 years, they've become an alternative to invest. And so let me just walk you through there's multiple different facets of a SPAC. From an investor like myself or you, a SPAC sponsor, usually a well-known individual, we can use anybody, will come to market and they will say, I am looking to launch a SPAC and let's use
it's usually somebody with a Warren Buffett of business, but except Warren Buffett wouldn't probably do it. But
not Warren Buffett, but like
John Malone.
Yeah, John Malone's a perfect example. John Malone's launching one through Liberty, so we can use him. So John Malone will come to market. He will say, I'm going to raise $300 million in a SPAC. And I have basically what that does is investors go and give him $300 million. He has a 2-year life to go out and find a transaction, and he will keep 20% on average of the the company that he raised. So he raises $400 million. It'll really be a $500 million vehicle, and he will get to keep $100 million of that, of the go forward equity. For investors, people would say, why would I give you that money? The benefit of investing in a SPAC is John Malone comes to market. I get to basically invest alongside him, or Richard Branson's another great example, raises 300 million bucks. I give him $10. He gives me a unit on IPO. The unit is comprised of one share of common stock that has a value in trust of $10 plus interest. So for $10, I get my $10 in interest, plus I get a warrant or a fraction of a warrant. So Richard Branson says, give me $10, I give him 10 bucks. I get the right to see the transaction he's going to announce. I can then either invest alongside it and go forward into the go forward SPAC, where I can redeem and get my money back, and I get to keep my warrant. So it's a really great type of transaction, and we can get into kind of the warrants and why those are a really valuable, misvalued instrument in the market, if you'd like, or we can talk about anything you'd like.
Well, keep that in mind. I have a few questions I wanted to ask you. So the redemption feature is like why this is a great thing to invest, right? Because it's I'm looking at the deal, I can get my money back and even keep a warrant, and then or I can go along if I love the deal, if I think it's going to be the next Nikola or space.
Virgin Galactic.
Virgin Galactic, right? And there are many of those these days. So that's awesome. And then I've done a few over the years, but they were always a little bit boring. Like I made like small percentages, but with very little risk. So I still loved it. But now the market seems different. Is it?
Yeah. So probably if you were investing in these, I mean, even as far back as 2016, 4 years ago, you had SPAC managers would come to market and they were smart guys, but they were investing in value businesses. They would think of this like a private equity investor and say, I'm going to come to market, I'm going to buy a great cash flowing business, or I'm going to buy as a single company private equity investment that they would own forever. So they were saying, look, I'm going to buy a great business, it's durable, I'm going to own it. Like there was one called Videocon, which bought DirecTV of India. It was a great business. It traded so-so and then it got acquired. But today what's happening is you're seeing actual growth companies come to market, because in the past year and a half, people have learned to understand that SPACs can be another alternative for IPOs. So today it's really IPO, remain private, SPAC, or now after this announcement yesterday, direct listing. So ideally, you can come to market with a SPAC if you're a growth company and keep a bigger portion of it. And the investors are built in, and it's great because you can bring companies that are in the EV space or in space or some other kind of niche or new space that people don't think about, charging stations or new types of healthcare. And once you do that, like, investors love this kind of stuff, and they're getting access to all these new types of businesses. Essentially, you've replaced the Series E or F round of a VC fund with now being a public company and allowing public investors to invest alongside you.
Yeah. And so, but doesn't it, like, I've always wondered if it doesn't annoy like founders if built like their company, and then this big shot business luminary comes along and he's like, yeah, I'll take you public, but I'm taking 20% of your company, and you get all this dilution. Why do they prefer it over like an IPO? Or
let's step back. So you and I are founders of a company. We founded it. We think our company is worth, I don't know, $1 billion, $2 billion. Just make up a number, $5 billion. Instead, if we were going to IPO, we are at whim of the IPO market. We have to see if the market would float us, and then we have to hope that when we float, our stock will trade well, and that we get a good investor reception. Instead, we can go to somebody. Let's use Richard Branson again. Richard Branson comes to us. He's a well-known person. He's got a cadre of institutional investors who've invested alongside him. Plus, he's got a well-known board, or a lot of times you have private equity guys who know governance, all sorts of things, and you can sell to them as a SPAC take their board, their people, so when you're a public company, you don't make mistakes. They can help you alongside, and you get to keep a bigger percentage of that company. So they might get 20% of the SPAC, but they might value us at a much higher value, or we might get to keep a lot more instead of us going to a VC fund and having to raise another round where we're going to give up more dilution. So it provides you these differentiated and better opportunities. Plus, you don't have to worry about the market. If you go and we sell to Richard Branson and he comes out and he buys our company, the market's going to then decide, and we get this downside protection, and we probably own more of our pro forma company than we would in an IPO or in a if we remain private and did another VC round.
Okay, so yeah, that's really interesting. I think it's super interesting what you pointed out earlier, that now they're taking growth companies public, and maybe that changed the dynamic around these things. It seems really obvious, but I never thought of it that way. And do you think that's now where all the action is happening, in those growthy tech electric vehicle names, or which industries excite you most?
It's funny because it was like probably about a year ago, you would see companies kind of push back going public because SoftBank was there, and SoftBank would come give you this big round, and you would raise money through them, get this huge valuation, and then anticipate to go public later on. And a lot of that money was made in the private markets. Like if you think back to WeWork or Uber or Lyft, how highly valued they were in the private markets, that when they came public, it was very difficult for the valuation to expand.
Right.
Today, we're seeing the opposite. So you have guys, rather than do that round, they're coming public, and we're going to see a lot of really great, well-known businesses that can come to market through a SPAC by partnering with people. So we saw like BarkBox, which is a direct-to-consumer pet company, come public last week. Engie, which is a charging point, ChargePoint, which is another SPAC, come public, which is charging stations for EV. You're going to see all these really interesting niche businesses in differentiated categories. You're going to see like new kinds of microchips, or electronic vehicles, or waste disposal, or space types of businesses where, these are fringe things where they're going to have a big life cycle in 5-7 years from now. They're able to come public today at a much smaller market cap and allow the market to figure out the valuation, as opposed to just VCs who have access to these types of businesses.
Right, and it sounds very geared towards millennial. I'm actually the oldest possible millennial, if we're being very generous with the definition. Do you think, are these really aimed at like the younger generation, or is it?
I think every single person wants to be a venture capitalist, and they want to have some sort of aggressive risk in their portfolio. I would say the aggressive risk isn't for everybody, but the SPAC allows you that way to invest in companies that could have explosive growth without taking that big risk. If I said to you, come invest in a space exploration company, or Virgin Galactic, or I don't know, some Nikola, or some sort of EV company, or a LiDAR company, you would say, okay, maybe I'm going to put 5%. This sounds very risky, but if you're going to invest in a SPAC where you're going to get to see the transaction, understand the business, diligence it, and say, this makes sense or not based on your risk tolerance, and then have the right to redeem, I don't see why you wouldn't want to invest in this type of structure.
Right. Yeah. I've always liked them, but actually because I've seen them as like lower risk, and so that's a bit different. But yeah, I think they're really fascinating and super cool, interesting companies are coming to market, and also some that I probably wouldn't touch. So it's a really mixed bag. Do you think there's like some things are getting overdone or a little bit too overheated?
Look, I don't. People worry, hey, is this a bubble? I would argue that SPACs aren't a bubble because you're investing in cash. So you're putting your money in cash. Now, are there going to be bad investments? if you buy pre-announced deal SPACs at a 50% premium. So SPAC IPOs.
I mean, those are around. Those
those are around. Okay. If you invest in 10, and there's plenty of them that I've invested in at 10 where they haven't announced the deal and they're trading at 50 because people make up a rumor and say this company is going to buy this, and they don't know. And then it comes out that they're buying something completely different. Your underwriting is a fair amount of risk. If you're taking a 50% premium to NAV, yes, that's going to be a problem. But if you're going to buy these things at or near NAV and hold them for a year or two and wait for a transaction, you're going to be rewarded very handsomely for your patience.
Right. Yeah, I can. That sounds very reasonable. And do you think with how traditionally I've used these to limit the downsides, maybe you get great thing for it, usually not. Now, are you actively trying to get to the best ones that will have that big pop that we've seen with Draftkings or the Nikola one or the Virgin Galactic?
What we're doing is we're going to build a fund. Our fund, and the way I structure our fund currently is to invest in the best SPAC sponsors. So the guys that have either this is their second or third SPAC, so they have proprietary deal flow. They're a well-known individual who has proprietary deal flow or some sort of specialized knowledge in a sector. I'm looking for guys that are going into a sector. So they're going to be in.
So Bill Foley ones, that's one you'll definitely look at, or
yeah, Bill Foley. I mean, I've invested in a couple of Bill Foley SPACs. Bill Foley he's a very good SPAC manager, and he's a good investor, and he understands the financial space because of his past life, and he understands how to make money in complexity and find regulation and insurance and different kinds of spaces where he can make money. There's guys in fintech, there's guys in EV or tech, or guys that are in consumer. And I'm trying to basically build a portfolio of different sectors that I can then back into, where I'm saying, okay, these guys are likely to buy something in consumer products. These guys are going to buy something in retail, or they're going to buy something in space or something far out there, or they're going to buy something in clean tech, and trying to balance our portfolio across the sectors as well as really good sponsors. And the benefit there is if we're able to do that, we can build a portfolio of really good businesses beforehand. I'm not trying to guess, and I'm not trying to go fly by night saying, hey, these guys are going to buy this company because somebody said this. That's not the game I'm playing.
Yeah. Yeah, and I do, I'm playing a little bit advocate of the devil in our conversation. Let's see. So you're really looking at the teams behind these deals, and there are impressive people who.
If guys are coming in and they're saying, "Look, we're going to buy a sports team," and they've done this before. There's a sports team that's rumored to buy the Red Sox, Fenway Group.
So Red Ball, right?
Red Ball with Blue Bean. But they know what they were doing, and they're coming in and they're saying, we're going to buy something in the sports space. So I can say, I can allocate part of my portfolio to that. I'm not going to buy the Me Too third guy who's going to come to market and say, I'm buying something in the sports space, because you're going to wind up owning some sort of, I don't know, e-gaming company that may or may not be worth money. And is that a risk you want to underwrite? Probably not. But if you own the one that's, hey, this is Billy Bean backed by a really good team, they know what they're doing, and they can pull this transaction off, in theory, it should trade pretty well. And if it doesn't, you still have warrants that are going to give you this option value that you can avoid the risk.
Right. And then some people are saying the sponsors, they get pretty nice packages. So they sort of are riding a call option and we are investing alongside them, but with not exactly the same option. So their hurdle to get a great return out of it is a lot lower. Does that bother you at all, or are you trying to mitigate that somehow? Or
so there's two things. Yeah, they are getting a good return. I'm getting this free look at the business. So again, they're going to get this return, but it's their name on the line. So historically, you would get these SPAC managers, especially when they were value investing or buying value companies. They were just trying to get any deal done. Today, you have guys coming to market, and if they announce a bad transaction, they can't come back to market. Because if you buy something and it trades to $6, there's no way you're going to raise your second SPAC. People are going to say there's a problem here, and I'm not going to invest in you. So guys know this is a problem. There was a SPAC sponsor, Chaim Saban, and he actually redeemed because when I met him, he said this has to be a resounding success. Otherwise, I'm putting my reputation on the line. And he wound up redeeming because he couldn't find a good deal and he didn't want to put his reputation on the line. And it was a fantastic show of how to be the right type of sponsor. And that's the kind of thing we're trying to align with. I don't want the guy who's just like, I'm going to buy anything. I'm going to be in a SPAC auction. We want to invest alongside the right SPAC sponsors who are going to provide proprietary deal flow. They know what they're doing, and they want to make sure that this is a business model. They're gonna underwrite SPAC 2, 3, and 4.
Okay, and how do you figure out whether somebody has like proprietary deal flow? Is that because he's like in the investment banking world, or
yeah?
like
And when you
venture
sit there,
capital?
venture capital. You sit there and you're like, okay, there's one more invested in Vivek Randaviv's SPAC, BOXU, and you can read the S1. It says we have relationships with the UC schools. We can see all sorts of deal flow. He sold TIPCO, so he was a venture capital. He was in the Valley. He has venture capital. He understands what a good business is, and ideally, he's going to buy a tech business. So you're underwriting a $10 unit with a warrant, and that warrant is pricing in cash. And once they announce a transaction and he could buy something, you get this convexity in the warrant. So what happens is the vol on the warrant is trading at, 10 or 15 because it's cash. And they announce they're buying a rocket ship company or a tech company or an EV company. That's where the real money's made, because if you're a Tesla competitor, Tesla's vol is 100 or 200. I don't know what Tesla's vol is right now. You're underwriting that. Your vol expands from 10 to 100. Your warrant's going to expand as well. The value is going to go up tremendously. So that is another way that you can really win in the SPAC market.
Yeah, so that's like super interesting, but I think we have to break that down a little bit because not everybody is investing in these things every day. You mentioned warrants a lot already. Maybe you can.
Let me step back. That's a good thing. So in a SPAC, the benefit is you get a 5-year life warrant. So it's a 15% premium to NAV. So what that means is when you invest in a SPAC at $10, you're handed a warrant or a fraction of a warrant with an $11.50 strike price usually. The value in that warrant will trade based on theta or time value because it's 5 years. But the vol is very low because historically it's just cash. It's not going to trade up a lot. Today we're seeing these things trade up, so you're seeing a little of the warrant accretion early on. But once they announce a transaction, if it's Draftkings or Nikola or something, and it moves up, QuantumScape, the warrant value will increase precipitously because people then say, wow, this is a real business. It has real growth and there's real vol attached to it. So not only does the underlying, if you think back to Black-Scholes, what drives an option value, you have strike price, volatility, interest rates, time. Your time is 5 years, so it's incredibly long. Your volatility is going to move up because you now have a real business that's going to trade. Your strike price is going to remain constant, and the underlying, in theory, should move higher. Because if you announce a real business that should trade at 15 times EBITDA, and it's trading at cash, and that's worth $40 or something as an intrinsic, your warrant price is going to trade up a lot too. So that's how you can make a lot of money in the SPAC market today, is by owning SPACs. And it also provides you somewhat of a net, because if you sell something too early, the way I manage my portfolio is I sell the common usually and hope I'm wrong. The stock moves up as I move out, but I paid nothing for the warrant or very little. I can hold the warrant as long as I want, because if the stock goes to 100, that warrant will continue to trade up. Now, the warrants do have a high-end cap at 1850, so they will move dollar for dollar. Once you get above 1850, the companies have the option to either exercise them at 1150 or through a share ratio, giving you common shares. But there's a great article by Josh Levine of Bloomberg about or Matt Levine, I should say, about warrants in Nikola from January that I can send you after, and you can link in the show notes if you'd like.
Oh, cool. So yeah, I've noticed that Capstone is actually pretty universal. That's at 1815, that upside cap, let's say.
Yeah.
And is it like a holdover from the traditional SPAC? Because it seems so unsuitable to these tech businesses.
Yeah, it's basically the SPAC structure hasn't evolved much. Bill Ackman has changed it a bit through his SPAC, the tontine structure, where if you stay in, you get additional warrants. He actually is buying, and he's got a differentiated kind of view, and that's what allowed him to raise $4 billion. But everybody else is kind of, hey, I'm going to try to raise between $300 and $500 million or $1 billion. I don't want to change the SPAC structure. I'm going to come at 10. I'm going to have a fraction of a warrant at 1150. It's going to be standardized terms. I'm not going to make it complex. But if I make it complex, it makes it difficult for people to kind of invest in me. On the second or third vintage, that's where we're starting to see negotiations. People are coming back to market, and I'm saying, hey, you got a deal done in 8 months. It was a good deal, but I don't think you deserve 20% again, because you're going to come back in another 8 months. And by the third or fourth one, we're doing well, but you're doing amazing. And there's got to be a little bit of a give and take. And a lot of the better SPAC sponsors today understand that, and they're willing to work with us and other institutional investors to give up part of their promote.
Oh, right. Okay. So that's super interesting, because I thought that was like a great move by Ackman, how he restructured that SPAC. And maybe if you want, you can explain what he did exactly. But he made it much more shareholder friendly, in my opinion, and really removed everything that's that can cause people to be skeptical about the structure. And because he did such a big one, he can really change the game even more. Bring some
Yeah, what he did was completely different than what anybody else has done. He created what's called a tontine structure. I think we've all seen The Simpsons. If not, you can go back to the Flying Hellfish episode and learn about tontines. But in a tontine, it's a holdover from World War II, where the last survivors will control whatever the prize is. So in this structure, if you invested in the IPO, and I believe it was a $20 IPO in 10, you got 1/9 of a warrant, as opposed to a third or half a warrant in most other transactions. However, once he announces a transaction, if you remain in his pool afterwards, after you don't redeem, you stay into the go forward business, you are going to share in all of the remaining warrants. So at worst, you're going to get another 2/9 of a warrant. So you'll end up with a third of a warrant, which is standard in every transaction. Or if a bunch of people redeem or sell, you can end up with more. So there's a possibility if he announces a deal that's not well received by the market and people want to sell, and you said, I'm contrarian, I believe in Bill Ackman, I think he's smart, I know what he's doing, and I want to stay in, you can end up with maybe a half of a warrant. We're not 100% sure, but it provides this really great kind of alignment. And he bought shares as opposed to be giving them. He struck higher out of the money. So his goal is to make sure that he produces a return that's far in excess, or he's got a higher hurdle rate than most other people. And because he's got so much money, he's probably going to buy a mega cap, well-known business.
Yeah, it's, I can't wait to see what it is. It's definitely going to make a lot of headlines. Let's see. So you mentioned like that these warrants have a lot of convexity, and you talked about volatility. Maybe you can explain that a little bit more for people who don't trade options.
Think about this. You own a piece of paper. That piece of paper is worth $10, and you have an option on that piece of paper that's worth $10. What are you going to pay for it? You're not going to pay a lot, because it's literally a treasury note. Now imagine that treasury note transforms into a company, and that company is a high growth business. Let's use Virgin Galactic again. So it's a space travel business that then becomes well received by the market because it's a new type of business. It's interesting. It's a comp to SpaceX, and it trades up 3 times. So it's at $30 a share. that piece of paper that you had a $10 option on, or you had an option on that $10 piece of paper, is now a real call option on a real business that has been appreciated by the market. So it's moved up, and you've seen this change in price. So what happens is the market now is going to value your warrant much higher than it was previously.
Yeah, but I sort of, maybe I'm mistaken, but it looks to me like sometimes that they're hanging around intrinsic value almost. Not all of them, but a
lot of them before pre-SPAC hang around intrinsic, and then once they announce a transaction, that's when you get that convexity, and it becomes a new business, and the warrant will then move higher.
Oh, it will. Okay.
That causes the rate of change in the business to change, because it's no longer tied to, hey, what would you pay for a 5-year option on a U.S. Treasury, and what would you pay for a 5-year option on Virgin Galactic? They're probably completely different, and that's what occurs. So that's where the benefit in the warrant or the warrant arbitrage occurs, because once you change from a SPAC cash box to an actual go-forward business, that warrant is going to have a completely different volatility and trading patterns.
Right. So I didn't think about, I like them, but I didn't think about it this way. So it's actually one of those much wanted long volatility trades where you, you benefit from
long volatility, and you don't know what somebody's doing. You're betting on a jockey, essentially, on a sponsor. And if that sponsor announces a really interesting or differentiated acquisition, you can really win. So you've bought, you own half of a warrant or a third of a warrant, struck at 11.50, and the stock goes to $20 or something, worth $10. Guess what? That's a home run. You paid zero for something that's now worth $10. When you invested $10, that's a pretty good return.
Yeah. So you really prefer to buy them close to $10. In history, you could get them below, but
yeah. And I think we've gone through periods, even in the past 6 months, where in August, we saw a ton of SPAC supply come to market, and we saw things trade at a premium to NAV. I think a lot of that was retail investors or institutions saying, this is a great asset class, I want exposure to it. Then in September and October, we saw a drawback or drawdown. We saw new SPACs come to market, especially units. Like the Richard Branson one was trading at $9.85. So anybody I talked to, they would say, what's the best investment? I would say, look, if I told you can invest alongside Richard Branson and I was going to pay you 15 cents for a warrant or an option to invest in him, what would you tell me? So I can redeem $10 and I get to keep a warrant. You're paying me 15 cents? Why would you not want to do that? And then the market kind of woke up to this. And we've seen all of these traded at a premium. I think his SPAC is now trading at $12. And then you're going to start to see, we're going to see a lot of issuance come in January. I think there's a ton, SoftBank's coming. There's a ton of S1s filed. There's going to be a lot of very, very well-known great sponsors that are going to come to market. And we're going to wait and see. Probably by March or April, we'll see if the market digests this or if we see another pullback, and it could create another really great buying opportunity.
And do you love these like super big names like Shamat or Richard Branson or which one did you just mention? Like
Vivek Randaviv's one, or which one?
Yeah, do you prefer like the industry specialists who built up like a name within their industry, or the general?
It's a mix of both. I mean, the coolest thing for me when I first was doing SPACs probably 5 years ago was having meetings with people that I had no business with. Like I can send you a photo of me and Richard Branson. Like, why did I meet him? I have no business meeting Richard Branson. And he asked me, I was in a meeting with him and Chamath, and he said to me, like, is this a good idea? I mean, like, why is he asking my opinion? I'm like, you're a billionaire. I don't know. I'm just some guy. I'm like having all these people come into my office and say, hey, I own this sports team, or I did this. And you're like, wow, you're a really, really great, you're a captain of your industry. And the way a SPAC roadshow works is it's really interesting. You're not allowed to have any target in mind or have any preconceived notion of who you want to buy until you list. So guys can't come in and say, they can say, I'm going to invest in tech or I'm going to buy in healthcare, but they can't say, you know, we're going to buy Virgin Galactic or we're going to buy this food company. you can't say that. So the meetings are incredibly open-ended, where you get to ask these really well-known business people all sorts of interesting questions, like, what do you think about interest rates? Where's the market going? What was your biggest mistake in life? How do you avoid a big mistake? How do you think about where you're going to be in 3 years? How does this go wrong? These guys can really explain to you kind of like how they look at the world. And if you do enough of these meetings, you get to, it's like hosting your own podcast. You get to get all these great guests every single day.
No, if it's like that, I want a job like that. That's great. No, but that's.
I didn't answer your question, but yeah, I mean, like guys like Chamath, like he has done this, and now he's on IPO D, E, and F, and
yeah,
he has a really great funnel. He has some of the best businesses, and he understands what makes a very good business in the public space. So he's a guy you want to bet on.
Yeah. Okay. Sure. So that's kind of a mix. Maybe we can go over like a few examples that you really like, and we'll talk about those. And I think your views will, become more practical for people who've never invested in NFTs.
Like what I try to do is find people who are really smart, who know what they're doing. There's a guy, Barry Engel. He runs a SPAC called Quell, Quell. I was actually on a panel with him last week. He was the former head of GM North America. So he understands the EV space incredibly well. I think people understand that he understands it now because his SPAC is trading at 1283. So you're paying a premium NAV, but he will likely buy something in the EV space. So if you wanted access to that, that makes sense. Another one, EQD, is run by Sam Zell. He's a world famous investor, I had a meeting with him and he taught me the only thing he learned in business school, he never went to business school, or he said, the only thing I learned was supply and demand. And when I think about stuff, it's always about supply and demand. And if it's oversupplied, how can I get the best price? If there's a ton of demand, how can I provide supply to that? And he has been on the right side of a lot of trades. So he's another guy where, his SPAC is trading at 1050. You're paying a 50-cent premium to.
Oh, that's interesting. I didn't know Sam Zell had one, but his nickname is the Grave Dancer.
That's the thing. He sold equity office at the top to Blackstone. So he's like the guy, hey, do you want to partner with somebody like that who he might not have, he has proprietary deal flow. I mean, I've had fantastic meetings with him in the past. He's a great investor. He'll tell you about how he invested in Mucinex, and how he invested in real estate and how he's done all these great things. It's like, you can work with a guy like that. I can't tell you what he's going to buy, but I know he's going to buy a great business at a great price. So
yeah, but he's going to buy like value. He's going to be deep value, because
it could be a really interesting growth business. I can't tell you what he's going to buy because
I'll take the under on that. But
no, I don't know what it's going to be. But the thing is, if you pay $10.50 for it and he announces something, could it trade up? Probably. Could it trade down? Probably. But you're underwriting a 50-cent risk, so it's a 5% risk to invest with Sam Zell. That's something you might want to do.
That sounds great to me, because I've got a lot of confidence in that he will find something great. I don't, I could see him take a long time, because he could.
I mean, he might be patient. He might wait for the market to pull back, and he might buy something that's very durable that he wanted to at a great price.
But it's definitely a diversifier in this market. And then you had this, did Sam Zell, he did not specify that it's going to be real estate, because that's his.
No, it's pretty open. Open.
Could be energy, anything. Let's see. And the other one you mentioned, that was AV and former GM executive, right?
Yep. That's Quell, Quell.
Yeah. And does it have a long way to go? Does he have?
He listed probably in I want to say August, maybe.
Okay. So
the way the market is moving now.
Mm-hmm.
When I talk to SPAC sponsors, they know a list of companies and they're getting calls every day now. So there's a really interesting, if you're a well-known guy and you're in the space, what you want to do is you want to invest with the right people who can separate out what's a good deal and what just is fluff or what sounds good. There's a lot of really interesting businesses, but are they good public companies? And that's what you want to make sure you're investing in.
Okay, and what would you say makes a good public company? What?
Well, so let's talk about like there was one that came through, two that came through SPACs. One is Utz, the potato chip company, through Collier Creek, which is a guy, Chin Chu, who was a former Blackstone executive. It was actually his second SPAC. He did one previously with Bill Foley. And he bought a family business, Utz, which is a potato chip company, knowing his know-how from Blackstone.
I think it's like one of the biggest ones in the world, right? In potato chips or something.
They're the fourth largest player. Frito-Lay, which is owned by Pepsi, is the number one player. But they have a lot of runway to roll up the space. And they understand how they had the right governance. They put together a top-tier board. They helped the management team really excel as a public company, where this could have gone to a private equity firm. Warren Buffett actually was reported to have wanted to buy it a couple of years ago. And now it's in the public space. So it's like, this is a kind of business that it's a good business. Everybody understands it. They've had tailwinds from COVID. And on top of that, there's multiple years of runway here. So this is a great public business that you are buying at year one. This isn't, hey, two other PE firms have owned this, put a ton of debt on it, and now they brought it public, and it's going to take a bit of time to work it out before it starts to grow. You don't have any of that. This can just continue to grow. And the stock has performed incredibly well. I think it's trading about $22 now, but for the next couple of years, I think it's going to continue to compound at a double-digit rate. And it pays a dividend.
Okay, so that's a fairly predictable business and a profitable business.
Yeah.
So you think those are like important characteristics, or?
Yeah, exactly. You want to have a good business that's going to have cash flow, that's going to have revenue, that just checks a bunch of boxes. That what you don't want to own is something where you're going to say in 3 years, why did I own this? This didn't make any sense. It wasn't profitable or didn't have revenue till 2027. And I got caught up in the hype. I try to avoid the hype and things moving a lot. Now, if you're underwriting a brand new technology, that's one thing. And a lot of the times there, I sell far too early. I sold QuantumScape probably 100 points ago or something like that, 80 points ago. But still hold the warrants. So I was wrong, but it's okay because I still continue to participate through the warrants without any of that downside risk, because participating in the IPO, I got the warrants at no cost. And there was no risk, so it doesn't hurt me in any way.
Okay, so that's nice that I'm not the only one selling things too early, but good for you that you still have the warrants. Let's see. So on one hand, you want to be a little bit careful with the too early stage ones, and a few of those are coming to market, and you kind of like some of the typical traditional metrics like profitability, but you also want a little bit of growth, I think.
Yeah, and the funny thing is when you talk to investors or you kind of get a pulse for the market, a lot of people don't want to own these good businesses because they'll say, I own SPACs for high flyers. There's a great one, Advantage Foods, ticker's ADV. It came through Jim Kiltz's SPAC with a guy, Dave West, they're both very well known in the consumer staples space. And this is a business that provides consulting to every CPG company, as well as if you ever go to Costco or Whole Foods, they provide the samples.
Okay, and what's a CPG company?
It's called ADV. A CPG is a consumer packaged good company.
Oh, right, okay.
And this is one that's a good business, generates cash flow, it's going to pay dividends, same kind of thing. And investors did not like it when it first came out because they said, I want my SPACs to buy something crazy. I want them to buy something that's going to be a high flyer, and this is just too boring for me. But sometimes boring is good, and if you can identify that, or you see people in the market are saying, I don't want this because it's boring and it's a good business, and they sell that, that's an opportunity. That's where you can be like Sam Zell and you can step in and say, okay, this doesn't make any sense.
Right. So so that's interesting. The food ones. If I'm not getting excited right away, that's actually a pretty good sign.
Yep.
That's good insight. And yeah, if we could like summarize it, or if you could like give your framework for what's like a perfect SPAC for you.
So Perfect SPAC is a very well-known sponsor where it's somebody who, you tell you're at a dinner party and you tell somebody, they say, what's a SPAC? And you tell them, you want to invest with Richard Branson or Chamath or XYZ, John Malone. What are they going to do? I'm not 100% sure what they're going to do, but they're going to buy something in this space, and you know exactly what the sector is that they're going to invest in. And that they're disciplined and that they have a track record of doing something like this. And the other framework is buying close to NAV. I mean, you're not going to always be able to, if you don't participate in the IPO, if you're not an institutional investor, you're not a participant in our fund, and you buy these in the secondary market, you want to buy them as close to NAV as possible. I mean, you don't want to overpay, because if you overpay, you're limiting your margin of safety, and that's where the real risk comes in.
Yeah, so it's like funds and like institutions, they can get like allocation before it even gets to the market. But that with the popular ones, it's actually even hard, I think, for or am I wrong?
Yeah, I think so. But there's so much issuance now. There's so many SPACs that if you don't go through a list or you don't focus on, hey, what are all of them? And you just go to the SEC website, you can look around, you can Google SPAC lists. There's a ton of resources out there.
I think there's like 200 this year or something.
Yeah, and then you can look through it and you can say, okay, go through it and pick 5 of your own, do your own diligence, because it's not that hard for you to say, I want to invest in a sector or I want to invest alongside this well-known business person. And if you pick the 2 and you can line that up and then you build a portfolio, because you don't want to just take one shot. You build a portfolio approach where you own percentage of a couple of them, then you set yourself up to really win or limit downside. And if you minimize downside, all you're left with is upside.
Okay, yeah, and I didn't let you finish about what you're looking for, but it's primarily that that famous investor.
Yeah, well-known or a sponsor who's done this before. So it's either their first SPAC.
Buy it cheap.
Yeah, and then if you can buy it at a good price, that's also important.
Yeah, but I see like a lot of people buying them at 12. Is that like is that where you're moving on to something else, or
it depends. It depends on who the SPAC sponsor is or what it is. I always separate my units, so I buy the unit, then I separate it, so I have the stock and the warrant, and then I can make independent decisions based on where I think either the market is going to be or if a certain sponsor is trading at too much for premium. Because you can email these people. They're publicly traded companies. You can email the management teams and say, hey, what's going on? Where do you stand? They're not going to tell you what they're going to buy, what they're looking at, but you can kind of get a feel for how they are in their life cycle, what's happening, how well owned it is. That's the kind of things that I'm looking for. And then you can create a dialogue, and any investor can do that.
Yeah. Okay, that's cool. And yeah, so you will, like, if you were me, you will like add a few to your portfolio, like maybe 5 or something that I pick in a way like this. But one thing that worries me a little bit, they're not that easy to understand. Like, there's a lot of complexity with the units, the warrants, the redemption features, and they're.
So let me just explain it, because it seems more daunting than it actually is. Mm-hmm. If the ticker ends in U, it's a unit. So that means it's bundled together with the common share and the warrant.
Yeah.
If it ends in W or WS, it's a warrant. And if it's just any other letter, then it's most likely the common share. So when you own a unit on the IPO, after 52 days, the units are able to be split. Only Bill Ackman's mandatorily split, but everybody else's remains as a unit. So you can go out in the market and buy the unit, or you can buy the common shares of the warrant, however you see fit. And then you wait for an announcement of a transaction. When they announce the transaction, it usually takes about 3 months for the SEC to register the S1 and for them to hold the shareholder vote. and they'll have a list and they'll say, okay, it's time for you to vote, and do you want to redeem or not? And you'll have a feature and the ability to do it. And at worst, if you think you messed up or you missed the redemption feature, you can sell it in the open market.
Right.
Because they trade at any time.
Right. And then the warrants are a little bit tricky, right? Because they have this feature that the company can redeem them. And I have to pay like attention if they're doing that, because otherwise my warrant disappears. Or
yeah, so that is a part of a little bit more nuance that people want to be aware of. So what will happen is there's two types of warrant exercise: cashless and cash warrant exchange. In a cash exchange, your warrants will be exchanged at 11.50. So let's just make the math easy. Stock's trading at 21.50. You pay 11.50. You've now bought one share of stock and you have a $10 profit because you bought 11.50. It's trading at 21.50. You've made the difference. In a cashless exchange, the company will do what's called a pricing period. They'll take a period of time and they will divide the stock price by the amount of shares, and they'll get a ratio. And they'll say, for every one warrant you have, you get 0.33 shares. You don't have to put up any money. You just exchange your warrants. And they'll mail you something. You'll get a notice. You will be aware of it. And if you stay on top of it, all you have to do is spend 5 minutes typing it in once a week into Yahoo News, and you'll see it. And these periods last 6 to 8 weeks. So it's not like, oh, it was a 5-day period, I missed it, and now my warrants expired. That's not a problem. People get worried because they don't pay attention or they've owned something and they kind of just let it sit. You got to do your homework here.
Okay, so it's something. And then are you holding any beyond the IPO date, or you already mentioned you hold the warrants, but do you hold any?
Yeah. So 1 second.
Sure.
Yeah. So we do, because basically the benefit I have where at my firm is that I can take a case-by-case basis. We are fundamental analysts. So I will look at it, and if somebody announces a healthcare deal or they announce a tech deal or an autos deal, I have colleagues or myself, and I can diligence it. So like United Mortgage got acquired in a SPAC deal. It was a massive deal through Gores. And Rocket Mortgage just went public. So I was able to look at where Rocket traded. I could say this should trade at a 1-turn discount to Rocket, or 2 turns. And I could create a valuation. I can say this is what I think the upside or downside case is. And if the stock is not anywhere near my case, I can hold it. And if it's above it, I could sell it. So it's on a case-by-case basis. Do I want to hold? I'm not redeeming everyone. I'm not selling everyone. Some I hold for multiple years. Some I sell on deal announcement. It just varies based on the transaction.
Okay, so not a definite sell there. Did you already? I don't know if we. What are like your favorite SPACs right now? If you had to buy a few right now, I don't know if you can talk about that. If you're in the process of buying them, probably you can't. But yeah, what are the most attractive ones that you can talk about?
I think what I would tell your listeners is to wait for January. In 2 weeks, we're going to see a ton of new issuance, and you're going to see a lot of SPACs that you can buy where you can participate, and you can buy them close to NAV because they're going to be new. So that's where, if you don't have any exposure to SPACs, I would avoid those. Today, the ones I really like, I would tell you the Chamath SPACs. You're not going to go wrong because he's done this so many times that your underwriting came to buy a good business, and he's got a very good track record. I like the Virgin Richard Branson one, VGAC, the Sam Zell one, EQD, Vivek Randavy's one, BOWX, and I think those are basically my favorites right now. There's a lot, but the hard thing is, again, I'm betting on an investor, and it's a cash box. So it's up to people to make their own individual decisions. It's not, we used to do merger arb, and I can just explain it in 1 minute. Like when you're underwriting a risk arb transaction, let's just make up a simple example. Coke is buying Pepsi, and for every 1 share of Pepsi you own, you're gonna get 2 shares of Coke. So Coke's trading at $50. They're paying $100 for Pepsi. Pepsi's trading at $98. I know I'm going to make $2 if the deal closes, and Pepsi came from, I don't know, $60. So I'm risking $38 to make $2. The risk reward is not very good because if the deal breaks, it goes back to where it traded before. If the deal closes, I make this. SPACs are the complete opposite. In a SPAC, I'm buying something at $10. I know where my risk is because I can redeem and get the $10 back. And if they announce a good deal, the stock's going to go up. So it allows you to kind of do your own diligence and say, where do I want to invest? Who do I like? And every person can justify, hey, what do I want to own? Rather than, what you want to avoid is the Me Too trades or the ones where you go on these message boards or different places and see everybody piling in and you say, oh, wow, it's at $14, I got to buy it. Now it's at 15 or 16 because those are the ones where you're underwriting at a 40% premium. Your risk reward is not as good.
Right. So if I have to summarize, and I think that sounds really good to me. Like you're looking for real quality teams. It differs how they look. You buy them pretty cheap when people are not yet excited about them on message boards before they announce a deal, preferably. And then once people get excited, you may or may not sell, depends on what your views are on the deal and what they've bought and how far you think it can run. You can hold it post IPO.
The goal is to practice patience because what you're really doing is underwriting a treasury-like return with a call option because they're going to announce a deal and you have additional call options through the warrant. Yeah. So if you can wait 8, 12 months, you might miss out on the market's move, but if you're willing to reduce that volatility and have almost no vol because you own cash and wait for these deal announcements, they can announce something tomorrow and the stock could be up 20, 50, 80, it could be flat, but I'm willing to wait and underwrite it and see what occurs.
Right. And that's a bit more higher risk, higher reward.
Yep.
Part of your portfolio. And well, the way the returns are structured, I guess like some are bringing in like a lot of returns and a lot of deals like more muted returns. Maybe you're having a great year where everything is bringing massive returns, I don't know. But is that why you diversify aggressively?
Yeah, so we're not hyper aggressively diversified, but we're pretty diversified, and that's just because the amount of sponsors that have come to market where there's so many really good ones. Where you say, okay, look, I'm going to own a 2.5 or 5% position. If you own a 5% position with no leverage, you own 20 names. I mean, you could lever these up in theory if you want because it's cash. You could own 40 names. And then you just wait to see what they announce. And again, like the 80-20 rule, you're going to have some that are really, really good, some that are more muted. In the past 3 months, we've had a lot that have been really good. Our performance has really shown because of that.
Cool. So maybe the last subject I really wanted to get into. And I'm a bit surprised that you don't like or haven't mentioned Bill Ackman deal. Are you not? I happen to own that one, so that's why I'm curious. Do you not like it, or
oh no, I
think the price too high?
I think it's he's going to do a really great transaction. Stock's at 25 right now, so you're paying a 20% premium roughly, maybe a little higher. So that's why I wouldn't recommend it aggressively versus something where you could buy a little bit cheaper. But
right.
Bill Ackman is a fantastic investor. He knows what he's going to buy. He's going to go out and he's going to buy 10 to 20% of a very good business. And he's talked about numerous things. He said, look, I'm going to buy Stripe or I'm going to buy Bloomberg. I don't know if he's going to be able to buy any of these assets. I don't know what he's going to buy, but I know the day he closes on an asset and what he announces, it's going to be on the front page of the Wall Street Journal or the FT. It's going to be on CNBC, and the stock is likely going to trade up. You are underwriting risk here because it could go down $5. You can trade to $30 now. So on a deal announcement, so it might be a 1-to-1 risk reward. Could go to 40. I'm not sure based on what he buys, but based on his track record and what he's done, it's likely going to perform well.
Yeah, and let's see. No, that's great. Do you think there's like an aspect of these specs that we didn't go over that's really important, or that we?
I mean, I don't know if there's anything else that we were missing. I think it's kind of
Maybe like there's some have an options market, but not like it's a minority.
yeah.
Is that informative at all about like the post IPO volatility? Because they're high vol markets.
They're incredibly high vol, and it's kind of
Yeah.
crazy because, like, I don't know why individuals would want to buy the options versus buy the warrants. Maybe they're
No,
nervous.
that's
But the warrants give you a 5-year or a multi-year time frame where an option could have 100 or 200 vol. So it creates another asymmetric way to create different payoffs where you can start doing a covered call transaction or strategy in these. The vols are incredibly high. Like in Draftkings, they were one of the first ones that had an option market. And if that occurs, you got to think, okay, maybe I'm going to get called away, and you have to be willing to be called away. It's a very popular strategy to sell puts in Pershing Square because people believe there's the floor and the stock shouldn't trade down. You just have to be willing to be put the stock. So there's definitely ways that you can collect kind of carry trades in the SPAC market through the options. I'm more of an option seller than a buyer for the SPAC market because I'm already long the option through the common or the warrant. So
right.
there's an option rich vehicle, so I don't need to take additional option exposure.
Yeah. The warrant, the difference between the warrant and the option is sometimes real surprising. I can, yeah, maybe it's because of the cap in the warrant, but it's
It doesn't make a lot of sense, but there's a lot of people that now have started to speculate in options that aren't as sophisticated or are new to the market, and maybe that's what's causing this kind of differentiation between the warrant market and the option market.
sure. Yeah, and then yeah, okay. So that yeah, I think then and then in January things are coming like SoftBank and what are like other big names that are coming to the market?
Um, there's a couple other
Or
ones. I
yeah,
don't want to say who they are yet,
okay.
because some of them, the S1s have been filed or they're going to be filed. There's a lot of testing the waters going on with really good teams. And we're starting to see guys come to market where it's a one-day marketed deal because they already know they've tested the waters and they know they have a fully subscribed offering. So
Yeah,
we're starting to see guys either upsize or cut back on who's going to invest. And there could be 60 IPOs in January. So if that were to occur, that would be 2 a day, maybe 3 a day. So I think like the first week, we're probably going to see 10 to 12 SPACs come to market. And there's going to be 3 or 4 of them, which are going to be really, really good, where you're going to say, okay, I need to own this institutional,
wow.
individual, retail, because you're just going to see who these people are. And if you just put a Google news alert for SPACs or you follow the news, you'll see who they are and you can participate alongside them. And some of them might be interesting to you and just trade at or near par. And if they're near NAV at $10 or slightly above, like it might be worth taking a shot on.
But so the market still feels like, I mean, you've got some insight into this. It feels really on fire still. Because I know like M&A and like IPOs, this is always a thing of waves. Like, I mean,
Yeah,
can the market absorb like 60 in a month?
yeah, because well, the IPOs they can because they're just cash boxed. So institutional investors are willing to invest alongside someone like SoftBank. So you're gonna say, okay, look, I'll get the money. They probably know what they're doing, and there's very limited risk to me. So we're gonna start to see the market can absorb. I think there was 70 billion in SPAC issuance this year. We'll probably see 50
Right. So
billion.
I could think almost of this like as dry powder in private equity. I mean, that's big too.
Exactly. So, and then if you think about it, the opposite of today versus 2000 is the amount of public companies is much less. The Russell 1000, I think, has 700 companies.
Yeah.
I think there's 330, I think there's $7 or $8 trillion in private equity portfolio companies. There's 300 or 400 unicorns that are worth at least $1 billion, if not more. So you're looking at 10 to 12 trillion dollars in cap that's available to be acquired. And there's probably 200 billion, 300 billion in SPAC dry powder out there today, and probably another 150 that gets raised next year. Is every transaction going to be good? Probably not. But is there enough good companies out there that every single SPAC sponsor can find one? Probably. Is everyone done at the right price? Probably not. But there's a lot of really good companies that can come to market.
Yeah, I'm really excited about that because I really hated how like public companies were dwindling. I think they halved in the U.S. market over the past decade or something.
Yep.
Let's say, I'm sorry to if I'm keeping you too long, please
No,
say
it's
so.
completely fine.
Okay, this like I noticed like a private equity sponsor or was part of this being the sponsor, and they like rolled over a company from that they already bought. And this is pretty common in private equity that they buy companies from other private equity
Yep.
firms, things like that. Are those things you avoid or
Yeah,
just look at the deal?
those are I look at them, but that's what I would avoid, because the last thing you want to do is if something has gone through multiple iterations through a private equity firm, it's probably has a decent amount of leverage on it because they've done dividend recaps. They could be great cash flowing businesses, but if the capital structure is wrong, it becomes a problem. So if you think back to Bill Ackman participating in one of the earlier ones, which was called Justice Holdings, which was a SPAC listed in London that bought Burger King, that then was the predecessor to QSR.
QSR? Oh.
Yeah, exactly. So, but that was a business that was private equity owned, that was upside down. There's no difference between Burger King and McDonald's in theory from their business models, but it was just the capital structure at Burger King was wrong. So if you're a private equity business and you come to market through a SPAC and they've raised $1 billion and they paid 12 or 15 billion for it, and there's a lot of debt here, and it's now a bigger cap company, you might not want to own that one, or you're going to have to diligence that one because that one is going to take a lot of time for it to actually be absorbed and work in the public markets, as opposed to a company with net cash that's in EVs or charging or space or something that's more high flying that could work, but also has a better capital structure. So the market's willing to underwrite that benefit of doubt.
Yeah, I can totally like get behind it. So in principle, that's like an avoid leverage argument a little bit, right? But on the flip side, if you get like the warrants for free, which become more valuable with more volatility, and you get a lot of leverage, that's a much more valuable free thing you're getting.
Yes and no, because
Okay.
if you have that, remember you have an 11.50 strike price on the warrant, so it's 15% out of the money. If the business is highly levered, what the SPAC market today is missing is SPACs can trade down. If somebody announces a bad transaction, it could be $8. We saw this with Multiplan. It traded to $8 or $7, and that was a private equity business that was acquired through a SPAC. It was a multi-billion-dollar business that has a lot of leverage. Not commenting on if it's a good or bad business, but that's one where it went to $8. And if that occurs, your warrant's going to fall in value just because you're further away from you're out of the money.
Yeah, I'm very aware that it can trade down because I'm like a value investor, and I often come across like failed SPACs from years back that definitely trade down a lot. And but there was a different times, and right now that's not really happening. But we'll see in 5 years.
Yeah.
And it has been so fascinating. I've learned so much from you, and really want to thank you for coming on. And maybe if people want to learn more about your firm or get in touch, or I don't know, maybe are you on Twitter or something?
Yeah, I'm on Twitter. It's at Evan Ratner. I actually have a monthly newsletter through Substack called Ratlinks.
Oh,
so you can go to ratlinks.com and you can follow along my musings. You can read, I actually wrote a whole thing about Virgin Galactic, about space travel when I met with Richard Branson back August of 2019. So there's an article there you can check out.
Cool.
Find me on LinkedIn, Bloomberg, wherever you want.
Yeah. Oh, maybe what was like a guy that you've met who really surprised you, like Branson or Shamat or something?
I mean, I've met a couple sports owners where they're telling me, "Hey, come sit in the luxury box."
Yeah.
I'm like, I don't want to do that. There was one. There was a podcast. There's a guy, Josh Wolf, who runs Lux
Oh
Ventures.
yeah.
He was on a podcast, Invest Like the Best.
Yeah, with Patrick O'Shaughnessy.
Yeah, and I think it was his podcast, and they were talking about how Subway got all of these Coke paid for Subway to put all of these like heated sandwich machines in, and why they did it, and how it was like Coke was paid for the capex. And then a guy who was actually the former CEO of Coke came in to launch a SPAC, and I asked him about it, and he explained from his vantage point about how Pepsi was going to steal the contract and how it was the opportunity cost of losing the contract was so much higher than them paying for the capex. It would have made sense. And I was like, this is amazing. Like, I literally listened to this yesterday and I heard this, and like, I can ask guys questions that I'm just generally interested in. So those kind of things are it's always great. Every SPAC does these group calls. So if you're an institutional investor and you can listen in, I highly recommend it because you can really hear differentiated perspective on the world.
Oh, cool. So that was very interesting. Sorry to lob that one at you at the end. Thank you very much, and good luck to you. And bye-bye. Thanks for the listeners for watching or listening, and please like, subscribe, and things like that. Yep. Thank you.
Don't think about it. Thanks, Brian. Smash that button.